When people first hear about cryptocurrency, they often assume that it functions just like money. After all, Bitcoin, Ethereum, and other digital assets can be used to buy goods, send payments, or exchange value online. However, in the United States, the Internal Revenue Service does not treat cryptocurrency as a form of currency. Instead, it classifies it as property, which means that cryptocurrencies are taxed in a manner similar to stocks, bonds, or even real estate. This decision carries significant consequences for investors, traders, and everyday users of crypto. To understand why this matters, let us begin with the difference between currency and property. Traditional currency, such as the US dollar, is simply exchanged without generating taxable events in everyday situations. When you buy a cup of coffee with cash, you do not need to record the transaction for tax purposes. On the other hand, property is considered an asset that can appreciate or depreciate in value over time. Whenever you sell or exchange property, the profit or loss from that transaction can create a taxable event. In 2014, the IRS issued official guidance that cryptocurrency should be treated as property for federal tax purposes. This means that whenever you sell, trade, or even spend cryptocurrency, you may trigger a capital gains tax. For example, if you bought Bitcoin years ago for $100 and later used that Bitcoin to buy something when it was worth $1,000, you would owe taxes on the $900 gain. The same rules apply to trading one cryptocurrency for another. Even though you never converted it into US dollars, the IRS still considers that a taxable exchange. This system places a significant burden on individuals who use cryptocurrency for everyday purchases. Unlike cash, every transaction must be carefully recorded, with the value of the asset noted at the time of purchase. Many people rely on specialized tax software or record-keeping tools to stay compliant. For active traders and investors, this can become quite complicated, as every movement of crypto is potentially a taxable event. It is important to note that not all crypto-related transactions result in the same type of taxation. Long-term gains, which come from holding cryptocurrency for more than 1 year, may be taxed at lower rates. Short-term gains, however, are taxed as ordinary income, which can be higher depending on an individual's tax bracket. Additionally, activities such as mining, staking, or receiving cryptocurrency as payment for services are considered income and must be reported at the fair market value when received. Some critics argue that this approach stifles the use of cryptocurrency as a medium of exchange. They believe that taxing every purchase creates too much friction for people who want to use crypto like cash. Others see the classification as a logical extension of existing tax law, since cryptocurrencies are more commonly held as investments rather than spent on small daily transactions. Regardless of one's opinion, the fact remains that in the United States, cryptocurrency is property in the eyes of the IRS. This classification will likely shape how digital assets are used and adopted in the future. As lawmakers and regulators continue to debate how to handle emerging financial technologies, tax policy will remain one of the most important issues for anyone who owns crypto. In conclusion, while cryptocurrency can look and feel like digital money, the IRS has made it clear that it is property for tax purposes. Just like stocks or real estate, it is subject to capital gains taxes whenever it is sold, traded, or spent. This rule creates both challenges and responsibilities for crypto investors and users, but it also highlights the growing legitimacy of digital assets within the financial system. As the crypto space continues to evolve, understanding how taxation works is essential for staying compliant and making smart financial decisions.